Hello, it's Nichole Story with Berkshire Hathaway, and today I am here with a very special guest, a dear friend of mine who specializes in a type of fund that you take your 1031 exchange and you exchange it into a fund. I'm going to let Ken tell you all about that today, and we're going to get right into it. So Ken, will you please introduce yourself and tell us exactly what it is that you do?
Yeah, thanks for having me on, Nichole. Ken Clidoris with Platinum Wealth Group, and we do 1031 exchange funds into a DST, which is a Delaware Statutory Trust, which is a way for individuals to, not have to go out and buy an actual piece of real estate when they do a 1031 exchange.
That's really nice. So the reason I thought that this was a really great topic is because I have so many clients that like to have investment properties because it's one of the best ways, if not, in my opinion, the best way to build your wealth and generational wealth. But the nice thing about what Ken does is that a lot of my investors, a lot of my clients that would like to invest aren't in the position where they want to be property managers. So they don't want to have that responsibility of even, say, hiring a property manager and that maintenance that comes along with owning residential investment property. So can you tell us why the DTS takes that completely out of the equation?
Yeah, so a DST.
Oh, DST.
Close enough.
Okay.
There's a lot of crazy acronyms, don't even worry
Okay.
about it. So yeah, DST is actually given by the IRS saying that it actually qualifies as like-kind property.
Okay.
So that's very important in the 1031 exchange, right? And I think it's important to think about what a traditional exchange is, just in case anybody watching doesn't know. So 1031 exchange is one of the most powerful tax advantaged things that you can do if you own real estate, right? It allows you to sell your property and defer all of your capital gains if you purchase another piece of real estate. Now, that all sounds great, but there are strict timelines and other things that you need to do and adhere to make it actually work. Right? You only have 45 days to identify what you're going to purchase. So that makes people very hesitant because they stress out. They're like, okay, I don't know when you're going to sell my property. And then if I sell, I'm in my exchange, I only have 45 days. What's that going to do? And it causes this fear of the unknown. And that keeps a lot of people from wanting to even look at a 1031 exchange. And the nice thing about a DST is you have surety of closing your exchange because you already have a DST available that's already closed, funded, and ready to go. You just get to pick from a menu, if you will, and say, these are the ones I want, and close. So usually we can actually close within that 45-day identification window, which is nice for most investors.
Yeah, that's fantastic. So essentially, if I was going to take your investment property and we were going to use a 1031 exchange, which is essentially a tax vehicle, so that you're deferring those capital gains taxes, or in some cases even regular income tax, but hopefully we're past that 2-year mark and it's considered capital gains. Let's say we're going to sell your property, your investment property, and we're going to exchange it into another investment property. Instead of having that stressful timeline of, hey, we got to go out and we got to find another property that cash flows or that gives us that profit that we're looking for, instead of having that stress, we can then reach out to Ken and he's going to say, okay, well, we're going to put you into this fund and here's what you can expect from that. Is that right?
Yep. I mean, ideally, if they want to own another piece of real estate, obviously you could go help them do that. But if they're tired of the property management or dealing with tenants' trash and all of those things, or maybe we had some rain recently and they're like, oh, we have a leak and we have some deferred maintenance and this really is not something we want to deal with, or a tenant moves out, now the cash flow is not even there and they decide to sell the property. It's in those situations where the investor really wants to step out of that day-to-day management and create a lifestyle and defer all of those capital gains taxes and other taxes, and again, preserve their wealth and turn that into income immediately. And that's why I really think this is a lifestyle investment, because it is really mailbox money where, the 15th of the month, that ACH is going to come, rent comes in like clockwork, and you don't have to worry about anything. So it's completely hands off.
So basically what you're saying is that you're turning this residential, or, for that matter, you must do commercial as well.
Yeah, anything held for investment can qualify for a 1031 exchange.
There you go. That's amazing. So basically you're taking this investment property, whether it's residential or commercial, and you're trading it into a fund. Now, what is the difference between a REIT and what this product is?
Yeah. Great question, because a lot of people do call DSTs a REIT because it kind of sounds like it and looks like it. But the interesting thing to note is that a REIT, you don't actually own real estate. So that's why it doesn't qualify for a 1031 exchange. And I'm sure people are surprised to hear that. But if you own a REIT, you don't own real estate. You own a business that happens to own real estate. And that's how it's tied. That's why there's REITs on stock markets and other things like that. Because again, you're owning an operating company that happens to own real estate. The DST structure itself is a beautiful kind of mix, if you will, and structure in that it allows co-investment into a single asset, DST, and the investor just gets to put in their cash, similar to like a REIT where they can just put in the cash and investment into it. But the property is already, in the structure of a DST, which means it qualifies for the 1031 exchange because you actually identify the address of the DST on your forms, and that's what allows it to qualify.
So what kind of properties are in a DST?
Yeah. So most DSTs are going to be institutional quality assets. Think Amazon fulfillment center, a Class A apartment building. For people around here, the stuff that the Irvine company builds would be very similar to the things you would own in a DST, but obviously DSTs aren't in California for cash flow purposes usually. But that would be the similar type of asset that we would own, or a corporate headquarters and things like that.
Oh,
so,
wow, okay.
Very institutional asset. Think 300 unit, apartment buildings, big institutional quality managers. Everything's professionally managed. A lot of the asset managers that we work with that actually manage the properties manage over $1 billion worth of real estate in the DST structure itself. So they have the expertise to get through a market cycle within the constraints of a DST structure to make sure that investor has a good experience and has a good exit at the end. Okay,
that's really interesting. Now, what kind of returns on investment are you seeing? I don't know how you quantify that, if you quantify it in yearly or monthly. I heard you say earlier that the investors in the DST are getting paid every single month. How do you quantify what the returns are?
Yeah, so there is monthly cash flow on most of the DSTs. And each DST that a client or investor would look at would have its own return pro forma. So they could create a portfolio of multiple DSTs and say, okay, we want this one, this one, and this one, and each one would have its own cash flow.
Okay.
Right now, we're looking at anywhere from like 4 to 6% net cash on cash return.
Okay.
So a lot of people, especially people that don't actually look very closely at their finances of like the breakdown of their real estate,
okay,
get confused between the gross number they get in rent check and what they actually get to keep at the end of the month versus like our fund paying them a net return that's everything's already paid for.
That makes sense.
And so yeah, sometimes it's a little apples to oranges.
Yeah, right. Because if you own an investment property, just say a single family residence, and you're paying a property manager, you're paying for repairs or whatever
taxes,
it is, taxes,
insurance,
yeah,
maintenance, all of those things that you maybe don't see every month.
Right.
But you just know what the check is, right?
Right. Yeah.
You're like, oh, that's how much I make. And then you think about it, you're like, oh, actually, I have to pay all these other expenses, especially in Southern California. Sometimes the properties don't even cash flow.
Right.
You're really looking for appreciation.
Yes.
Whereas in the DST structure, these cash flow from day one, but you're not going to get the appreciation that you would get in a single family house in CDM or in Southern California.
Right.
Right. But they don't cash flow. Where these assets really are, again, lifestyle, returning that property into a cash flow that's every month, very passive, that you get to go out and just enjoy life and figure out what's more important to you at this moment, other than managing your real estate.
That makes sense.
And going out and like spending time with family or whatever you may want to do at that time.
Now, as far as appreciation goes, because we know that we are extremely fortunate in Southern California, like our appreciation is some of the best in the country year over year over year. I mean, it's phenomenal, and there aren't a lot of states that match that. So that said, there are clearly so many great things about this strategy as far as taxes. And I know that when we talked before, a lot of people do take deferments on their for their income taxes on their rental properties and things like that, depreciation, excuse me. But as far as appreciation goes, if someone is really banking on that appreciation, say for like later in life, for retirement, or for like generational wealth, having that to pass down to their children as far as inheritance goes, what would you say the difference of appreciation is? I don't know if that's even something that you can quantify, or if you can just tell me what kind of what you see as far as appreciation goes on these funds?
Yeah, I think that's a great question. A lot of people look at that. The important thing to remember here is that if you do the 1031 exchange and go into a DST, you're preserving your net worth because you're not paying all the tax. So even if you were to, let's say, get a better return doing something else, if you lost 30 or 40% of your net worth starting the transaction, you have a long way to get back to where you started.
Oh, that makes sense.
Right?
Yeah.
So because we're doing the 1031 exchange, we're actually keeping your net worth higher,
Okay.
preserving your capital, and creating a better cash flow off of that income for you to have.
Okay.
Right? Does that make sense?
Absolutely.
Yeah. So that's the first thing. And then I would say on appreciation, each asset class is going to have a different return profile. But again, we're looking at, high single digit annualized returns would be the expectation based on track record. And then again, you'd want to look at the DST itself, which one you're going into, location, and there's a lot that goes into that. But if you look at historical records, I would say high single digits total return is what you're going to be looking at. And then from an estate planning perspective, it's much easier to give shares of a DST or split different DSTs amongst your heirs, as opposed to trying to divvy up a piece of property amongst your children, say.
That makes sense.
Right? So if you know your kids are going to fight over the property, you're going to sell it immediately. If you pass and there's going to be some type of fighting, it's much easier to be like, hey, we decided to do a DST or 3.
Yeah.
Here you guys go. Here's your income. Once the property sells, you can take the cash and do what you want. But in the meantime, we've cleaned up our estate plan from that perspective.
That makes a lot of sense. Okay. And then, so say I have a client and they do a 1031 exchange, and let's just, for the sake of conversation, say there's $1 million that they would like to, purchase shares of the fund with that $1 million. Let's say that in 2 or 3 years, they, for whatever reason, want to get that money out. How does that process work?
Yeah, so sadly, and this is a conversation I'd have with the investor at the beginning, there is no secondary market for DSTs.
Okay.
So you're basically, for lack of better terms, you're in it until the property sells.
Okay.
And that's going to be, about 10 years.
Okay.
For a whole market cycle, depending on where we are in the market and things like that. Obviously, interest rates and the general real estate market is going to affect that. But on average, we like to tell investors it's going to be a 7 to 10 year hold.
Okay.
And in that time, yeah, you can have the cash flow, but the equity that you put into it and that capital is tied up to that piece of real estate until that property sells.
Okay.
Now, that being said, if there was some extenuating circumstance where you're like, I need this money, there is mechanisms for you to reach out with the other investors in the fund, and somebody could offer to buy your shares.
Okay.
That being said, anytime you fire sale anything,
okay,
somebody's going to offer you something,
right,
and you might not like the number, but you probably could get out.
Okay.
But you're not going to be whole.
Okay. So basically the DST is really for somebody who wants to stay invested in the real estate market, wants a passive cash flow every single month in their mailbox with no hassle. They will still see appreciation. Since 2020, our appreciation in Southern California is, 40%, right? That is so astronomical compared to most years. Most years in residential real estate, we see a 3 to 6% return. So we're within the realm of a typical real estate investment anyway, or potentially a little higher, depending on the year, potentially a little lower if you're looking at 2020 through 2024, which again is unusual. But you're going to see your returns, you're going to see a monthly cash flow, you're going to see appreciation as well. And you still get your write-offs for your taxes, correct?
Correct.
Yeah.
So you maintain your net worth.
Mm-hmm.
You have passive income, which is, again, if you own a single family home here, it's probably going to be better in a DST than it is in your rental property. And you're going to maintain net worth, ease of operation because you don't have to worry about anything. The check just shows up. They're also in a DST structure. You don't have to worry about maintenance and things. The cash flow from the property covers all of those expenses as well.
Okay.
So you don't have to worry about somebody calling you and saying, hey, we need a new window or toilet's broken, we need extra cash.
Okay.
That's not something that happens.
Okay.
And then yes, from the tax perspective, you do get all the same benefits of owning real estate directly. So the same things you were seeing before, from depreciation and interest expense and all of the costs that go into running the property,
okay,
all still flow down to the individual investor in the DST structure.
Okay.
So you get the tax sheltered income as well.
Okay. So it sounds like almost all benefit. The only thing that is different is it's not as liquid as say a single family residence or duplex, because if you needed to sell that tomorrow, you would basically get market value for that in most situations, right? In most markets. But as long as you have the intention on being in it for the 7 to 10 year mark, sounds like it's all kind of an upside.
Yeah, I mean, there's different things that can happen in the real estate market, right? We still own real estate. We're still subject to, the national economy and the local economy, wherever it may be, interest rate risk and all of that still comes into play, right? Because this is an operating business in real estate. And the other thing I would add is that the lack of control is the big thing for a lot of people, right? Because you just have to be comfortable with knowing like there's a professional manager that, maybe does 10,000 or whatever units like this and manage it. You have to trust that they're going to do a good job.
Okay.
If you can get past that, a DST could be a great option for you.
So it's not for my micromanager clients.
No, definitely not. Like if somebody likes to go walk around the property and like look at the door and like check the paint and like talk to the tenant, like that's way too active. Like they're more of an active investor.
Sure. And we'll just 1031 you guys back into residential real estate.
Exactly. Go find them something else and they'll be happy.
Exactly. Yeah.
But for the ones that are like, hey, my kids moved out of state, we're going to be traveling a lot. Like the last thing we want to do is still have this piece of property.
Right.
But then they talk to their CPA and they're like, there's no way we're going to spend this on taxes. And then they don't know what to do.
Right.
That's a great option because now you can, again, defer all the tax, get all of that appreciation that you've experienced over the last couple of years in your piece of real estate here and diversify it into a stabilized asset that's cash flowing.
That's nice.
Yeah.
Okay. How did you get into this business?
Well, not on purpose.
Well,
kind of on purpose.
Okay,
but yeah. So I originally was a financial advisor, and because this is technically a security, you have to be a financial advisor to offer it to clients.
Okay.
And so over the last decade, really just crafted a expertise in the 1031 space and DST specifically. So yeah, been doing it for over a decade and just really enjoy it. And when it comes down to the complexities of identifying and doing the exchange and making sure everything is appropriate and like the loan to value is there, and creating that portfolio for the investor that meets their goals, liquidity, and everything else, it's just something that I'm really passionate about and really enjoy.
Very good. Okay. Is there anything else that we didn't cover?
No, I think we covered it basically at all. The only thing I'd say is that for a lot of individuals that have never done a 1031 exchange or done a DST, it can feel very uneasy. The nightmare that I own is better than the nightmare I don't, or I forget exactly what what I'm talking about. For some reason, I can't think about it right now. Like if you own real estate and there's problems, like the problem that I know is better than the problem that I don't.
Oh, okay. Yeah, that makes sense. Yeah.
And so a lot of people, when they've owned their property a long time, they already have it in their mindset of like, this is what to expect.
Okay, I see what you mean.
And they kind of plan for it because it's all feels natural and reasonable.
Yeah, right.
So they become comfortable with kind of like the expenses and how the property operates.
Controlled chaos.
Yes.
Yeah.
And so the idea of losing that and buying something else makes them stay in that.
Right.
And then the idea of giving that power to somebody else to manage is a little like, almost like it's too good to be true.
Right.
And they're like, oh, I'm so used to all of this back and forth and this chaos.
Sure.
Like the idea of somebody else doing it is uneasy as well because they've never done it before.
Okay.
And then you add to that the idea that they've probably never done a 1031 exchange.
Sure.
And then they'll Google it and it's going to be all these negative things and how the exchange can go bad and they can have the tax bill anyway and like you might not find a property and you have all these rules and like it becomes overwhelming for somebody that's never done it before.
Sure.
And I think that's why it's really important to work with professionals like yourself and me and accommodators that really are experts in their field,
right,
to make the process as seamless as possible.
That makes sense.
And really ensure that the investor has a good experience and nothing falls through the cracks.
Okay, yeah, that makes sense. Yeah. And to kind of recap for you, as far as a 1031 exchange goes, there's not that much on your end that you need to know, except for you, in order for you to qualify, for your property to qualify for a 1031 exchange, it will need to be an investment property for 2 years. And what that means is that if you, for some, have say a second home, that wouldn't qualify for a 1031 unless you live there under 14 days a year. So if say you have a second home and you're living there 6 months out of the year, that does not qualify for an investment property. So you need an investment property for 2 years for it to qualify for a 1031. Then once we get that on the market and get it sold, you then, like we said, you have 45 days to identify another property, and you roll your profits into a 1031 exchange into another property. And so you're not paying those taxes. So that is the benefit of a 1031 exchange. We talked about this the other day. You actually have to purchase like for like. So if you sell $1 million property with a mortgage that of say $300,000, you still have to keep that debt, and it has to be the same amount of money that you sold the property for. Is that the right way to explain it?
Yes.
Yes. Okay.
Yeah.
Exactly.
So some people think, oh, right, the profit's like what I bought it for versus what I sold for, and that's the profit. I keep the rest.
Yes.
And there's ways that certain deals that you can do that in, but in a 1031 exchange, you have to roll all of the proceeds
Yes.
to completely defer all the tax.
Right.
But that being said, if somebody wanted to do a 1031 exchange and let's just say like wanted to pull out $250,000,
Yes.
you could do that, pay tax on the $250,000, and then roll the additional funds into the exchange and defer all of that tax.
Yes.
So you still get that option,
Right.
but to have a completely tax-deferred exchange, it needs to be all of the proceeds plus any debt.
Yeah, like for like.
Yeah.
Right. Okay.
Well,
Perfect.
as we talked about that,
Yes.
let's talk about like what like-kind property is, because sometimes people get confused
Yes.
in a 1031 exchange. When they see like-kind property, they think if I own a house, I need to buy another house. And if I
Right.
own land, I need to buy land.
Yes, that makes sense. So when I say like for like, I mean price-wise.
Yes.
But you can basically take any investment property and 1031 it into another investment property.
Correct.
Yes.
It doesn't matter if you own a single family house, a duplex, whatever.
Commercial, yeah.
Do a 1031 exchange as long as it's held for investment.
Yeah, perfect. Okay.
Yeah.
Is there anything else that we should know about this?
I think that it's a great introduction, and anytime anybody wants to have a conversation or get into the details, be happy to have a conversation.
Perfect. Okay. Thank you so much, and we will see you next time.